in listen-only mode.
Welcome. I'd like to thank you for joining us today. TimeValue Software is pleased to present today's webinar on Day 2 accounting for your troubled debt restructurings. My name is Marty Pellerin. Today we're going to show you some easy to use mechanics and some examples of doing Day 2 accounting per FAS 114 and ASC 310 using TValue software. Our banking and credit union customers have said this process has made their life easier, and the CPAs and examiners have said the documentation has made their life easier, so it sounds like a win-win to me. The Day 2 accounting is also called the accretion calculation, and it should be done on a monthly basis or at least on a quarterly basis to tie back to your call reports. And the accretion adjustment is basically based upon the payments being made, or it could be based on the changing of the risk factor. So if you change the risk factor, it's obviously going to change the cash flows. And as payments are being made, the ALLL or ALLL will be reduced. So the amortization schedule that you produce actually has a significant amount of information that you need to do the calculations for those that are making timely payments. And what I want to do now is take you to the Excel schedule. This is something we actually do in the TValue product. We actually export to Excel. And when we do that, we actually have a significant amount of information available. So the day one accounting is what you do on the first day. So if you have a TDR loan modification for $200,000, the net present value is $189,000. Your allowance for loan loss is $10,000. So on a month-to-month basis, if you look at just the interest differential, so this will be the interest income from the TDR schedule, and this is the interest income from the loan modification, the net present value schedule. If you just look at that difference on a month-to-month basis, that is effectively doing a net present value calculation every month. That interest differential is the adjustment that you have to make. So this $280, $281, $282, that's your monthly adjustment. If you're going to do it over a period of a year and it looks like this, you might just want to take a midpoint of $285, and that would be your adjustment every month for a year and just adjust it at year end. When you get to year end, if you made all these adjustments, you would have $3,100. $3,137 would be your total of the monthly adjustments. If you look at the balance at let's say year end, this is 12/1, your balance is $196,000. If that agrees with your quarter system, all the payments have been made timely, you can actually use this number. The net present value of those same cash flows at the same point in time is $189,000, so your allowance at that point is $7,400. So once again, you can take these TDR schedules if you're using TValue, export the TDR schedule, export the net present value, line up the payment lines, and you have most of the information you're going to need. So let's go see how this works. So now we have those cash flows, and we have our allowance amounts. So the allowance was $10,560. The allowance at the year end is $7,400. So our accretion adjustment for the year is $3,137. And what we do recommend is you do it on a monthly basis. So you would be debiting the allowance account for $280, crediting the provision for bad debts for $280. We actually had a conference once, and one of the CFOs stood up and asked the CPA, he's like, I put that credit to an income account. And the CPA says, no. He goes, it's actually a reversal of a prior entry, so it should go to the bad debt account. So that's for the vanilla accounts that happen to make all their payments on a regular basis. What happens when you have irregular payments? You have payments that are missed. You have partial payments. You have accelerated payments. You have a change in your loss ratio component, either up or down. Now what? Well, now you have to recalculate. So what we would do now is we go to TValue. Let's go right here. And what I'm going to do is open up a new schedule. And let's say we have, let's go back to our PowerPoint real quick. I got this set up for us. Let's say we have $285,000. We have an interest rate of 4% on our loan modification. Say the payment amount is $1,432, and we want to figure out how many more payments are left, because this is irregular, so it's probably out of sequence. If you're going to balloon it at the maturity date, that'd be one strategy, but we're just going to let the payments flow out over the remaining term so it pays off the loan. The reality is, on net present value, if you're looking out long term, the difference will be negligible. So, and then the effective rate's 6%. So let's go to TValue, open a schedule, and I won't put on a label and all that. We're just going to go through this quickly just to show you the exercise. So the nominal rate would be 4%. That was the modification rate. We'll just use today's date, $285,000. Put U 1432, U for unknown for the payment, calculate, and we have a partial payment left. Put it as a balloon, hit OK. Here's my TDR schedule as of 5/2/2013. Now I want to do my net present value. Go back to 6%, U for unknown, calculate, 230,000. So basically I have about 55,000 as my loss at this point in time. So very simple to do. If I change my loss ratio, it was 100%, now it's going to be 95%. I could factor that 1432 and then recompute my my net present value calculation. So what happens if you have that zero net present value calculation? So you put it into a TDR pool, you put a 5% factor on it, payments are being made. What you do is you get to reduce that pool. So each payment, if it's 5%, you have a $1,000 payment, you get to reduce it by $50. So it still works the same. You get to recapture it as that balance goes down. So a quick summary: if loans are tracking, use the amortization schedule. You have all the information you need. It's going to be very close. This is a reserve, so you just don't have to be exactly to the penny. If the loans aren't tracking, we do recommend that you do it at least on a quarterly basis. We quote rebid, so you're going to figure out what your new allowance is based upon the information you have. And it's actually a real simple process. Hopefully you don't have 1,000 of these to do, but if you ever need any help down the road, feel free to give us a call. Our number here is 800-426-4741. You can send emails to info@TimeValue. I get all those, so I can respond to them. And once again, you can always give me a call. My name is Marty. Once again, thank you for participating today. Thank you. Appreciate it.